Welcome to our first quarterly in-person update for the third quarter. It's been another strong quarter in terms of returns. We've had returns of about 2 to 3% across the strategy funds, adding to already strong returns over the last year. And people might be surprised at that, given some of the risks and, some of the bumps we've had in the road over the third quarter. If we think about the unrest in July, we had heightened Chinese regulations that also came through in July. And more recently, global inflation has, started really rearing its head in a scary way again. So we're going to speak to a lot of those things, but I'm first going to hand over to Izak, who will just recap on what we see is happening globally, taking into account the risks that are coming through from inflation.
Yeah, thanks, Monene. I think the main thing to remember about inflation is that underlying is really very strong consumer demand for goods. And these goods need to be produced and shipped and distributed. And it's in that process where there are a lot of bottlenecks, interruptions, disruptions, supply chain issues. And that's really what's causing the inflation rates. There's just everywhere shortages of key inputs. And that is largely because, the pandemic is still making life difficult. COVID is still making life difficult for users. So the general view is still that inflation rates will subside. Number one, as consumers shift spending away from goods towards services. And number two, as suppliers kind of get their act together. Clearly, there's a risk that if inflation rates remain at these elevated levels, then the market is going to start questioning whether we're going to see low inflation, and the market's going to start worrying about what central banks are going to do, and whether central banks will have to hike rates faster than expected, and whether central banks will have to generally reduce stimulus. So it remains a big risk, even though we don't think that is how it's going to play out.
And Izak, if you look at South Africa, we had the unrest in July. What is the outlook for the South African economy?
I think notably for South Africa, growth has been a lot stronger than expected, certainly than anyone would have expected a year or so ago. And we've really benefited from very high commodity prices across a range of our exports. We've also benefited from low interest rates and a recovery in consumer spending. So it's been a much better picture than expected. That's also eased some of the fiscal concerns because tax revenues have been much better than budgeted for. So things have so far turned out to be better than we would have thought. Despite the July unrest, there's also been, it looks like, a recovery from the lows of July in terms of the initial numbers that we have on the SA economy. We should expect that things will moderate in the next year or so. So we're not going to keep growing at these kind of very heady growth rates, but I think where we'll end up with is still decent medium-term growth of around 2%. And that's certainly positive broadly for South African assets.
Thanks, Izak. And that's, allows me to move on, just speak about asset classes. While the July unrest was awful, it shows the extent to which those kind of risks are already priced into our asset classes. So despite all of that, South African equities actually had a relatively good quarter, despite the volatility towards the end. And our managers have done very, very well navigating the market. So going through the pandemic, we had more exposure to rand hedges, which did well for us. But managers moved into commodity shares. That was a really big boost to performance. And while people might have been worried about domestic companies, the valuation was on offer. And that's ultimately what has guided our underlying positioning in funds. And managers have moved more into domestic shares, and that has been rewarded by good returns. I think people are worried about commodity prices and how we've navigated that. But our managers early in the second quarter already started taking some money off the table and readjusting their portfolio. So despite the volatility we've seen within the commodity group of companies this quarter, our portfolios have still done well. Our market remains cheap. And so we still see a lot of opportunity from the domestic asset class. That's quite different, I suppose, to what we have globally. Global equities have also done incredibly well in dollar terms. They are more expensive than what we have locally. But Andreea, if you could just speak to us, what has happened within the global equity market over the last quarter?
Thank you, Monene. So we saw over the last quarter, we saw the MSCI World Country World down just over 1.1% in US dollar terms. And we saw the month of September pretty much registering the largest monthly loss of around 4.1% in US dollars since March 2020. So it's been a fairly rough quarter for global equities in general. Now, despite this setback, global equities did manage to deliver a positive return since the beginning of the year, just over 11% in US dollars. And certainly this doesn't come as a surprise, as global companies to deliver very healthy earnings, well ahead of market expectations, especially in regions such as US and Europe, supported by pent-up consumer demand, as we saw the lockdown restrictions continuing to ease in these areas of the world. Now, given this very supportive background, it's certainly not surprising to learn that global equities continue to look very expensive from a valuation perspective relative to their own history. And that is because they continue to price in a healthy recovery in earnings going forward. Now, within global equities, however, we had a dichotomy in that emerging markets lagged their developed market counterparts so far this year, with most of that underperformance having actually come through during the last quarter, when we saw the MSCI Emerging Market Index down just over 8.1% in US dollars. And with that return having essentially wiped out all the gains that emerging markets had accumulated during the first half of the year. Now, most of this underperformance was in fact related to the weakness in Chinese equity market. And that's been driven particularly by concerns around heightened regulatory risks.
Thanks, Andreea. It has been a choppy time. I mean, our view on global equities is that it is a very broad market. As Andreea said, you've got different regional markets in there, but a lot of different sector exposure as well. And we aim with our manager selection to balance those risks and also to gain exposure to cheaper parts of the market. So our value managers in particular have done very well over this period, while our emerging market managers have clearly lagged. And we believe that balanced approach to global equity is still an important part of our portfolios. But if we move to South Africa again and just look at South African fixed income, it has continued to be a big exposure in our funds. Ameer, what are the key highlights of what has happened within the space over the last quarter?
I think first point I want to make, Monene, it's a big exposure, rightfully so, and we've certainly seen very strong double-digit returns in the last year from the bond market, about 12.5% in our fixed income funds. If we took a conservative view and went into cash, we would probably have returns, negative real returns. So we're quite pleased with our manager positioning. And certainly we have seen a lot of volatility in the bond market, with the US Fed speaking about tapering and expectation of higher interest rates. We've seen interest rates in emerging markets increase quite considerably, for example, Brazil. And but relative to, if you look at South Africa, our inflation expectations are generally well anchored around the 4.5%, and that's out to 2023. So while we are under no pressure to actually increase interest rates, I don't think we have the luxury of having ultra accommodative monetary policy in South Africa. And that's because of the fiscal metrics which we deliberated as a team, and some of the other concerns about our debt trajectory, etc. So yes, over the short to medium term, we are likely to see a movement in, higher interest rates locally, which we have seen in our global peers in the emerging market space. So I think what's important is that based on our manager positioning, we are positioned on the long end of the yield curve, and we know that we are getting healthily compensated for the risks that are embedded in the South African market, and these all the structural impediments that we speak of, high levels of unemployment, the education, etc. But the fixed income market is compensating us for the risks which we are well aware of. And yes, we are likely to see volatility. But I think if we lean into the valuation and take advantage of the huge risk premiums we're getting, certainly the outlook for fixed income is very positive.
Thanks, Ameer. As you say, the view on inflation is a critical part of that positioning, and that, you know, our positive view on fixed income. It underpins the real return that you're going to get from bonds, and as you say, it will also determine to what extent you know, the SARB will raise rates from here. So we are still very positive that inflation will remain contained, but that is, you know, a risk that we as a team monitor on an ongoing basis. For now, you know, we are happy for the trajectory for inflation going forward. But Andreea, I want to come back to you, because I think China's been the big story this quarter. It obviously impacts our global funds or our global position, but also it's a very big factor in the South African equity market, given our exposure to NASPAS and Process, with Tencent as the main underlying investment. So I think people still have a lot of questions around what's happening in China, how are managers positioned, and how do they see the path going forward?
Thank you, Monene. Indeed, as mentioned earlier, there was really a string of negative news that came out of China, particularly around the tighter regulation across certain sectors. So you saw the Chinese government towards the end of July announcing pretty much an unprecedented move to turn private tutoring companies into non-profit organizations. Clearly, this would have affected the profitability of those companies. However, although this seems to be a very industry-specific change, it certainly raised concerns amongst investors that other industries could also be impacted in a similar stance. For instance, online gaming, which obviously led to a massive sell-off in related Chinese stocks, including Tencent, and by extension, NASPAS and Process, both those stocks being listed locally, and both of them making up quite a large percentage of the local market. However, it's probably worth noting that this is certainly not the first time we witnessed tighter regulation in China. We've certainly seen this movie before, and we expect our active managers to consider such risks, especially when they continue to play themselves out when analysing company fundamentals, and more importantly, as part of the portfolio construction process. It's also worth noting that our global equity managers continue to maintain exposure to Chinese companies. And interestingly enough, whether they're more growth-oriented or value-oriented, all of our global equity active managers have exposure to China, which really talks to the opportunity set available in that region of the world. So they have maintained the exposure to Chinese companies, particularly those who seem to have more diversified sources of earnings, and have certainly shown an ability to withstand such regulatory tightening cycles in the past, and they continue to survive this change in regulatory landscape by finding alternative sources of growth, and have been able to do that in the past really well. So despite this, our managers do recognize that regulatory risk is a lot higher today than it was previously, and therefore we haven't seen them adding to their Chinese exposure post the recent market sell-off.
Thanks, Andreea. So while there is definitely still opportunity in China, clearly the risks have increased, and our managers are managing those risks. But the regulatory change wasn't the only news in China over the last quarter. We also had some news from the property sector, a big Chinese property company that is in trouble. Clearly, China is important for our economy. Lots of the demand for commodities come from China, and that was also driven a lot by their property sector. So it's like, if we look at how that is played out, how do you see the impact playing out for South Africa and for growth in China in general?
Yeah, so Evergrande is a giant property developer that is really teetering on the edge of bankruptcy. And at the time of this recording, we don't quite know yet how it's going to play out. But I think the bigger concern is just that property development and investment in residential property has been a huge part of China's growth story over the last 3 decades. If you think about those sort of double-digit growth rates that China has posted. And I think that story has now run out of road. You know, irrespective of what happens to Evergrande specifically, I think just the fundamentals of the property sector in China is quite weak. There's oversupply. There is a tightening in terms of funding. Demographic trends have turned against property, and urbanization trends have slowed down. So we really shouldn't expect the kind of strong growth rates that we saw in China in the past persisting in the future. Now, that doesn't mean that that economy is about to crash and there will be no growth. I think there will still be very strong growth in terms of, you know, consumer spending as consumers, you know, spend on services, spend on goods. But the demand for commodities might be very different. So if you want to think about it very simply, I think in the South African context, companies like Naspers through Tencent Holdings will probably continue to do quite well. But I think some of the commodity markets, some of the commodity companies, you know, there's going to be a shift in demand. Certainly, we're not going to see the kind of massive demand for the likes of iron ore and steel and so on in China in the future, because that property sector really was a huge driver of that demand.
Just speaking to what has happened over the last quarter, it's such a stark reminder that one can't forecast the future. While we do a lot of work and a lot of analysis in trying to understand the risks that are out there, as well as the opportunities, one can never really predict how things and different risks play out completely. So we've spoken a lot about things that have gone wrong, but there's also a lot of opportunity. If we look at South African asset classes, they remain very cheap. Sentiment to South Africa remains poor, and so there's still a huge opportunity for returns in our market. We balance that in terms of how we build the portfolio, so we've still got a healthy exposure to global equity. But given how assets are valued locally, we think there's still an opportunity to build on the real returns that we've seen this year and over the last few years. So thank you very much for joining us today for our first quarterly feedback of this nature, and we're hoping to do the same again in the new year. Thank you.